We are drawing the reconciliation statement. Budget profit. Now adjustments for variances. So in the adjustments for variances, I told you we always begin with the sales price. And sales price, the formula is budget selling price minus actual selling price. You multiply by actual units sold. Budget selling price minus actual selling price. You multiply by actual units sold. So if you look at our budget, the selling price was meant to be 17,500, and the actual price turned to be 18,000 if you look at the actual results. And the number of units that were actually sold, they were 3,000. So give me that variance and tell me whether it is favorable or adverse. Ian, use your two names. Use your two names, please, so that we know who is this Ian. Use your two names. Yeah, I can see 1.5 million favorable, 1.2 million favorable, no, 1.5 million. So it is 1,500,000, and it is favorable because we managed to sell at a higher price. The next one is sales volume. Now, sales volume is given as budget sales units minus actual sales units. You multiply by standard contribution margin. So according to our budget, we thought we could sell 3,000, but we ended up also selling 3,000. And if you look at the budget statement, contribution per printer was 5,500. 5,500. So obviously this one reports at zero variance. That reports a zero variance. The next one is materials costs. So material cost variance is given as standard material costs minus actual material costs. Standard material costs, you minus actual material costs. Standard material costs, you minus the actual. So now, according to our budget, one printer was supposed to cost us 6,000. So if you multiply by the actual printers, 3,000, that gives you the standard costs. Then you will go to the actual budget and find that we ended up using 18,900,000. We ended up using 18,900,000. So give me that variance. Give me that variance. Waiting for the answer. Yeah, good. Ibrahim, 900,000 advance. So we have 900,000 advance. It is advance because we paid more. Now from there, we are supposed to go to labor. And in what I taught you in class, we were just using the total labor. But in this question, we will not use the total direct. Reason being, the assumption called linearity has been violated. Has been violated. If you remember, what we normally do when it comes to something like hours, tunachukua the hours per unit in the budget, like 1.25, then we multiply by the actual hours. Then we multiply by the actual units, 3,000. If you are to do that, 1.25 times 3,000, we were supposed to record that 750. Now this one is based on the assumption of linearity, that the number of hours taken will depend on the number of units produced. But when we introduce running curves, which we had last time, it says that as you do more units, time taken gradually declines. Time taken gradually declines. So based on that, we were supposed to, I think, we got 1795. So that is the reason why we shall not use the total. We shall use the components. Just a minute. So if we are going to use the components, then we know that labor cost is a makeup of two items. One is labor rate. So tutakuja hapa tuseme labor rate variance. So the labor rate is normally given as standard rate minus actual rate. You multiply by actual hours. That is the one that we are going to use. Standard rate minus actual rate, you multiply by actual hours. So when you go to the budget, you realize that 1 hour was supposed to be paid for 3,000. But in the actual, we paid that 250. The actual, we paid that 250. And then the actual hours that were used, they were 1,700. So give me that answer. Give me that answer. For 25,000 advance, according to Ibrahim, for 25,000 advance. Okay, someone else to confirm? Make sure you are confirming. You are confirming the figures. Yeah, good. Even Cyrus, Emily, good. The next one is labor efficiency. Labor efficiency. Now, labor efficiency, the formula is standard hours minus actual hours. You multiply by standard rate. Standard hours minus actual hours. You multiply by standard rate. So from our workings that we had the other day on running cabs, we were able to establish that the standard hours are 1795. The actual hours are 1700. And then the standard rate we know is 3000. The standard rate we know is 3000. So work out that and give me the variance. Yeah, good. I can see them coming. 285,000 favorable. 285,000 favorable. So these two, when we combine them, they give us the total that we should have had. Let's go to variable overheads. Variable overheads. So variable overheads, you know we also use the total, but because the question says that the variable overheads are 60% of labor, the same effect we have had in labor of non-linearity will therefore be experienced in variable overheads. So if it will be experienced, then we will also have to break down the variable overhead sort of variance into the two makeups. And you know, the first one is expenditure. So expenditure is given as actual labor hours multiplied by VOAR minus actual variable overheads. Actual labor hours multiplied by VOAR, you minus the actual variable overheads. So the actual labor hours are 1,700. VOAR will be 1 hour. 1 hour is paid for 300. And the overheads are 60%. So you multiply by 0.6. So that is our VOAR, 1,800. 1,800. And then when you go to the actual results, you find that the actual variable overheads were 3,400,000. 3,400,000. So based on that, give me the variance. 340,000 advance according to Cyrus. 340,000 advance. Yes, Marim confirms Emily. Good. So that figure should be okay. We proceed to the next one, which is called efficiency. Efficiency. So for the efficiency, the formula is standard hours minus actual hours. You multiply by VOAR. You multiply by VOAR. So the standard hours, we already know they are 1795. The actual hours, 1700. And then VOAR, we know it is 1800 from this one here. It is 1800. It's 1800. $171,000 favorable, good. 171,000 favorable. I can see it from Ibrahim, from Marim, Cyrus, and Emily. Okay. So we are through with variable overheads. Let's go to fixed overheads. Fixed overheads. Now, fixed overheads, there are two components. The first one is called expenditure. And we say expenditure is given as, yes, even Ian confirms it. It is budget fixed overheads minus actual fixed overheads. Budget fixed overheads, you minus the actual fixed overheads. So according to our budget, if you remember the budget we have just drawn, the fixed overheads were 5 million. And when you go to the actual results, you will find 5,075,000. 5,075,000. So that gives us 75,000, which is advanced. Which is advanced. Now the other variance that we are supposed to compute is volume, but I told you volume is computed when you have stocks, when you have closing stocks and opening stocks. But this question does not have any, and therefore we will not compute. That being the position, we therefore bring the actual profit here so that we come to the end of the statement. The actual profit, when you look at the actual profit, you can the actual result, you can see it was 21,100,000. And now remember, when you are reconciling, we say you get the budget profit, you add the deliverables, you less the advance, you will get the actual profit. You get the budget profit, you add the deliverables, you less the advance variances, you get the actual profit. So do that and tell me whether it reconciles. So you say yes or no. Manuel says yes. Wamushi says yes also. Hamide, Hussein. Yeah, teach, good. So that reconciles, and therefore we should proceed to the next question, not unless there is any query that is raised. Okay, so let us go. Yes, John, I can see that. Cyrus, I can see. Let us now proceed to November 2019, question 1. November 2019, question number 1. Examine 3 benefits that might accrue to a business organization as a result of good ethical behavior by management accountants. As a result of good ethical behavior. That question has been brought from what we call ethical standards. I brought it from what we call ethical standards. And you should remember them so clearly. The ethical standards. Now, just to remind ourselves, the types that we have, or the categories, number 1 is called integrity. Number 2, what tunaita competence. Number 3, huwa inaitwa objectivity. And number 4, we call it confidentiality. Those are the 4 ethical standards that when you are practicing accounting, you should be able to uphold. So that was not the question. The question was about the benefits. So I want to quickly give you the benefits. 1, there is competitive advantage. Competitive advantage. Number 2, it is attraction and retention of the best workers. You are able to attract and retain the best workers in the company. You are able to attract. Or attraction of investors and capital. Let me put it that way. You are able to attract investors and so on. So I don't want to invest much time there. Those are things that you can easily get on your own. But I think that is a good guide. That's a good guide. Therefore, I seek to proceed to part B of the question. Justify why in the short term some costs and revenues are not relevant for decision making. Some costs and revenues are not relevant for decision making. So that one, if you track it visually, you'll be able to find it somewhere we call non-routine decisions. Non-routine decisions, that is where you will find it. And a few things that you need to bring in mind is relevance for you to be able to answer that question. Now, first of all, relevance is the ability to influence or to be influenced. To be influenced by a decision. That is what we call relevance. It is the ability to influence a decision or to be influenced by a decision. Therefore, what do we mean by relevant? Relevant actually, relevant now can be said to be, I think, let me put it here, because they are more or less the same thing. Relevant here. Because something is relevant if it has the ability to influence a decision. Something is relevant if it has the ability to influence a decision. So irrelevant, so something is irrelevant. Something is irrelevant if it has no ability to influence a decision. If it has no ability to influence a decision. So that is how you are supposed to build your case so that now you can tell us why in the short term some costs are irrelevant. Costs. So we'll say some costs are irrelevant. In short term, because they remain unchanged. They remain unchanged irrespective of activity level. Activity level in that period. Such costs are known as fixed costs. So some costs are irrelevant in short term because they remain unchanged irrespective of activity level in that period. So they don't affect the decision that we make. And such costs are known as fixed costs. And the same concept applies to revenues. The same concept applies to revenue. Some revenues are irrelevant in the short term. because they remain constant. They remain constant. They remain constant within that period. Within that period. Within that period. And this is because of king demand concepts. King demand concepts in perfect competition. Perfect competition, which prevents change in prices. It is something we call the king demand in something known as perfect competition. Perfect competition market, and it prevents change in prices. Prevents change in prices. So for your own, if you don't remember what is this, maybe you can check later. But that is the reason. But the key thing here was just for the student to say there are some costs which remain unchanged. There are also some revenues that remain unchanged. That was all. So if we are okay with that, we should proceed. Are we okay? If we are okay, say my yes. Yeah, good. I can see the okays. Let us go to part B or part C of the question. Part C says, Fairdeal Limited uses a third-party delivery service to deliver goods to customers. The current average cost per delivery is shillings 125. Fairdeal Limited is considering establishing an in-house delivery service. A number of factors could affect the average total cost per delivery for the in-house delivery mode. The table below shows the possible average total cost and the probability of each one occurring for the in-house delivery mode. So we are given all that. Required, get the expected value of the average cost, and then you evaluate the decisions. So that question is coming from decision theory. Decision theory. And I want us now to prepare the analysis table. And in this analysis table, costs will be our xi. And then we have the probability. Probability will be probability of xi. We will have a column where xi is multiplied by probability of xi. And then we will have a column where xi is reduced by x bar, then we square, then we multiply by probability of xi that way. Those are the columns that we shall require for us to answer that question. So the costs are 105, 107, 105, 107, 110, 121, 125, 126, 142, 156, 158, probabilities are 0.05, 0.10, 0, 8, and 12, 14, 16, 12, 18, and 5. This should be 1. So let's quickly multiply. So 105 times 0.05, I have 5.25. This is 10.7. 110 times 0.08 is 8.8. 121 times 0.12 is 14.52. 125 times 0.14 is 17.5. 126 times 0.16 is 20.16. 142 times 0.12 is 17.04. 156 times 0.18 is 28.08. 158 times 0.05 is 7.9. So I add 28.08 plus 17.04 plus 20.16 plus 17.5 plus 14.52 plus 8.8 plus 10.7 plus 5.25. I am getting 129.95. So I believe we have gotten that. So now this one down here, you will come and now tell us the expected value. We are looking for the expected value. The expected value, that is the x bar, it is the sum of the xi's. You multiply by the probability of xi's, and that is the one we have gotten as 129.95. You can even take it to be 130. So that being okay, I proceed here. Itakuwa ninasema 105 minus 129.95 squared I multiply by 0.05. I multiply by 0.05. So the same thing here, 107 minus 129.95 squared 0.10. So you do the same thing mpaka chini. So sasa nitakuwa nasema 105 minus 129.95. We square that, multiply by 0.05. Okay, I'm getting a very high value of that 1.125125. Yeah, Ian, good. Then 107 minus 129.95. I square that, I multiply by 0.1. I'm getting 52.67025. So the rhythm continues. 110 minus 129.95. Square that, multiply by 0.08 is that 1.8402. 121 minus 129.95. Square that, multiply by 0.12. I have 9.6123. 125 minus 129.95. We square that, then you multiply by 0.14 is 3.43035. 126 minus 129.95. You square that, multiply by 0.16 is 2.4964. Here niko sasa hapa kwa 142 minus 129.95. You square that, multiply by 0.12. I have 17.4243. 156 minus 129.95. You square that, multiply by 0.18 is 122.14845. 158 minus 129.95. You square that times 0.05 is that 9.340125. Sasa hiyo ukisema plus 122.14845 plus 17.4243 plus 2.4964 plus 3.43035 plus 9.6123 plus that 1.8402 plus 52.67025 plus that 1.125125. I'm getting 310.0875. Are we getting that figure? You're getting that, you say yes. Yeah, Wamusie, Cyrus, Eva, good. So now we are told to advise on yes, Orina. We are told to advise on what would be the best cost. On what would be the best cost. So the advice will be coined like this. We will have decision maker. And even put it like in a table. Let me put it in a table. So that I have decision maker. Then tunaulizwa we advise on cost selected, and then we will have an explanation as to why he has done that or why we advise that way. So the first decision maker is risk neutral. Risk neutral. Now, risk neutral is a decision maker who does not compute risks. He works on the expected values. So for him, he will go for 126. He will go for 126. Why? It is the nearest. It is the nearest to the average or to the expected value. To the expected value of 130. That one. The 129. So the average is 130, is what it should have gone for. But as you can see, in the set of the values, none of them is 130. When you study statistics, you will discover this is one of the disadvantages of the averages, because the answer you get may not be one of the values that you have. So if it is not one of the values, then you go for the nearest. You go for the nearest. Haya, huyu mwingine wanamuita risk averse. Risk averse. So risk averse, they are fellows who go for the smallest risk. They go for the smallest risk. So remember, risk is measured using variances. These are variances. So utakibia kwa hii column, you pick the smallest. And the smallest is this one. This is the smallest of all, the 2.4. So that one is corresponding to the price of 126. So you still take 126 because it has the smallest risk as measured by variance. As measured by variance. as the smallest. So that is the reason why they will go for that. And then finally, we have this other guy who is called risk taker. Risk taker. Now, risk taker will be going for the highest. They are the fellows who go for the highest risk. So kwa hizi zote ile iko na the highest risk ni hii 122. So 122 ni hii ya 156. So him will prefer that because it has the highest risk as measured by variance. As measured by variance. That is what he will go for. If you are okay with that, write for me the word proceed. If you have any query, you raise it. Ibrahim says to Soge, Eva, we proceed. Yes, Juma, carry on. Emily, we proceed. John, Cyrus. Marim. Okay. Question 2, tunaambiwa QHY manufactures the product branded Tamu. To manufacture a unit of Tamu, 3 ingredients are required. ABC, currently QHY Limited is operating at its full capacity of 28,000 hours. The product is manufactured in batches of 20 liters. The current production data is provided as follows. We have that. During discussion on the budget of the year ending that 1st of December, the sales manager estimated that sales volume might grow either by 50% or 75% provided the required machine capacity is available. While assembly capacity could be increased and meet the projected growth in demand, the machine capacity of 28,000 hours cannot be increased. Therefore, in order to take advantage of the buoyant market, the management is considering the purchase of one of the three ingredients. The following quotation has been received from an external supplier. So we have been given that. The management has decided to buy only one ingredient in any one financial period. Now, required, evaluate which ingredient and the quantity of the ingredient to be outsourced if production is increased by 50% and 75%. And 75%. So that question is coming from what we would call product mix. Decisions. It's a case of product mix decisions. And if it's a case of product mix decision, we always begin by assessing. So let me just go on and draw the analysis table. We always begin by assessing the resource, whether it's scarce or not. So we have the ingredient here. We have the ingredients, or we have the details. Then we have do I give it a title or let's delete this one. And we talk of capacity. Capacity, I want us to analyze the capacity of 100%, capacity of 150%, and capacity of 175%. The capacity of 100, 150, and 175. So the units, if you want to know the units that can be made, first of all, we are told we have 28,000 hours. Now, these 28,000 hours, they are enough to make units taking 6 hours, 10 and 12. 6, 10, and 12. So if you divide 28,000 by these three, tell me how many units those are. So that we know at 100% or currently how many units we are able to make. Yes, Jared is telling me 1,000 units. 1,000 units, good. Can see the 1,000 coming very fast. So what you need to do is now to tell me 1,000 multiplied by 1.5 will be 1,500 units. Those are the units at 150%. Then 1,000 multiplied by 1.75 will give us 1,750 units. 750 units. Then from there, I want to come and deal with labor hours. Are they labor hours or they are what? They are calling them machine hours. So machine hours. Machine hours. So in machine hours, for ingredient A, ingredient A, we will argue like this. It will be 1,000 times 6. That is 6,000. This other one, it will be 1,500 times 6. If you take 1,500 times 6, it will be 9,000. Then 1,750 times 6. 1,750 times 6 is 10,500. Then I go to ingredient B, which requires 10. So it will be 10 times 10. That will give me 10,000. Then 1,500 times 10. That will be 15,000. 1,750 times 10. That would be 17,500. Then I go to C, which requires 12. So this will be 12,000. 1,500 times 12 is 18,000. And 1,750 times 12. 1,750 times 12 is 21,000. So with that, I will be able to get a figure called required. I'll be able to get a figure called required. Now the required, you simply add. So tukikuja kama hapo utasema ni 6 plus 10 plus 12 is 28,000. I have 9 plus 15 plus 18 is 42,000. 10 plus 17 plus 21 is 49,000. $9,000. Then you bring the available. The available is 28,000. 28,000. 28,000. So that from there, the difference is the shortage. The shortage. I did that, now should be the end of the table. So here we don't have a shortage. Here we have a shortage of 14,000. And here we have a shortage of then be 15. No, not 15. It's 21. Yes, good. Gerard and Ian, 21,000. Haya, from there sasa unajua vizuri sana, we prepare something called the first principles analysis table. First principles analysis table, where we have details, and then we always begin with contribution margin. Then we get the key factor per unit. Then we get contribution margin per key factor, and then we have the rank. Those are the four things. Ibrahim, at why we are increasing the percent by 100? I'm not really getting what you're asking, but I guess it's about this, this, and this. If it's about this and this, the question says we are going to increase by 50%. So if you increase by 50%, nikumaanisha from where you add 50. And the beginning point is always taken to be 100%. So 100 plus 50 takes us to 150. Then we ongezea 75%. So 100 plus 75 gives us 175%. Then if 100 is 1,000 units, 150 is how many units? 175% is how many units? Is that what Ibrahim, you are asking? Good. So I hope now it's okay. So if that is okay, let's get the ingredient A. Ukienda kwa information 3, you find that ingredient A, we are supposed to get it at 290. But ukirudi hapo nyuma, the variable cost of ingredient A is 200. So that tells you it has a contribution margin of 90. It has a contribution margin of 90. And we know that it has, for B, we have 320. This is B. We have 320, and the variable cost is 220. So that gives us a contribution of 100. For C, we have 390. And we have a variable cost of 240. And that should give us 150. The key factors in his hours. This one is 6, this is 10, and this is 12. So hii tukasema it is 90, you divide by 6. 90 you divide by 6, I get 15. Then 100 you divide by 10, you get 10. 150 you divide by 12. 150 you divide by 12, I get 12.5. And then based on that, we have the rank. The rank, this must be number 1, this is number 2, and this is number 3. So sasa tunatengeneza kitu inaitwa allocation schedule. Allocation schedule at 150% capacity. At 150% capacity. So we always begin with the rank. We always begin with the rank. Then I will have the ingredient. Ingredient there. Then I will have maximum demand. Maximum demand. Then I will have what we call key factor. Now, key factor, we begin with per unit. Per unit. Then we have required. We have required. And then we have available. Then we have available. Then from there we say units made. Units made. Then we again bring the key factor. And this key factor, we talk of the used and the rest or the remaining. This one is number 1, number 2, and number 3. Number 1 is A, number 2 is C, and this is B. Maximum demand at 150. All of them are 1,500, 1,500, 1,500. Then per unit, this is 6, this is 12, and this is 10. And the required, they are the ones we had, 1,500 times 6, this is 9,000. 1,500 times 12, this was 18,000. And this is 15,000. And the available is 28. So up to that point, I have not added any value. I've just copied what we already have. So ukifika hapo niambie there so that I can proceed. When you get there, type the word there so that from there now we start adding value together. Yeah, good. I can see we are there. We are there. Good. So this is how you argue. This is how you argue. We want to make a 1,500 units, each taking us 6 hours. That means we must have 9,000 with us. And we already have 28, so we can afford. So if we can afford, we make 1,500. And in so doing, we will have used 9,000 so that we are left with 19,000. We are left with 19,000. The 19,000 becomes available for number 2, which requires 18,000. And if it requires 18,000, we can afford. So we make 1,500. Tuwe tumetumia 18,000 and we are left with 1,000. We are left with 1,000. Now the 1,000 here, the 1,000 cannot be enough here because we require 15,000 hours. So we ask ourselves, with 1,000 hours, how many units can we make, each taking us 10 hours? And you realize that can only be 100. So we make 100 so that we have used 1,000, and then we are left with 0. We are left with 0. So down there, the summary or the conclusion is that we have ingredients, units made, and then units outsourced. Units made and units outsourced. Units made and units outsourced. So for A, we are able to make all the 15,000. So you don't outsource anything. For B, we are only able to make 100. We are only able to make 100, and therefore we will outsource 1,400 because we require 15. For C, we are able to make all the 15, so you don't outsource. We don't outsource anything. So this one, we just outsource B. Are we okay at that point? Yeah, good. Before some of us start leaving, I was thinking this Sunday we can meet for 4 hours. This Sunday we can meet for 4 hours. From 8:30 to 1. Is that okay? From 8:30 to 1. Let me see how many are okay with that. Okay. I can see Timothy is okay. Gerard is okay. Ian, Haika. Yeah. Cyrus, good. Yeah. Eva, good. So budget for that so that we can try to do some few more questions for 4 hours. But our Saturday class remains. The next thing, you will draw the same table kama hii. Good. And see further confirmations coming in. At 175%, you draw another table like that, but the changes will be here. This now will be 1750, 1750, 1750. Then you get the required here. The available remains that way. Then you decide. And then you come here and tell us how many units you will outsource and how many you will not outsource. So I believe you can handle that on your own because I can see time is over. So handle that on your own. We will now handle the next question in the next lesson. Thank you and have a good day.
Lakini Kim unajua anakuanga keen sana.
Kim
Anakuanga keen sana kwa vitu kama hizi.